Friends, very good morning on this, December 6th. Today is a very interesting time. This is the month of festivities, and this is the month where we have a lot of celebrations happening, a lot of parties happening, and we just thought, why not actually kick off this party? You've seen that we've been talking about ETF for a long time, and I thought it was a good idea to showcase another very, very interesting thing. We spoke about this last year in a slightly different format. And this year, we want to talk about ETF again because now the noise is getting louder. And ETF is something that now we cannot further ignore anymore. And I think can become a very, very interesting proposition going forward and in years to come. So let's sort of start with the presentation. We'll start with the basic disclaimers that whatever we are doing here, purely educational. There is no advice of any sort, and nothing that we say should be considered or construed as any sort of investment advice. And basically, we are sub brokers and AMFI distributors, etc. So let's just go ahead. So friends, let's talk about ETFs. ETF in the simplistic format means exchange traded funds. Now, you are already aware of what a mutual fund is, right? So when we are talking from a mutual fund point of view, I think that understanding is very, very clear in today's world. It's a collective investment. All of us pool in our monies, and we have the large household names in the country who are running these mutual fund companies. What we do is we put money in a predefined scheme. They have hundreds of schemes, right? I'm just doing a very quick recap on mutual funds. Of course, none of you need it, but this is just for the sake of completeness, so you appreciate exactly what an ETF is. So just the way the mutual funds so far have launched hundreds of schemes, there are hundreds of equity products, debt-oriented products, multi-asset products, etc. In the same format, in the same fashion, just the way we are making a collective investment here, we are making now a collective investment in something called an exchange-traded fund. It is a fund. Ultimately, it is absolutely the same thing. It is a fund. It is manufactured by pretty much the same manufacturers, which is the same mutual fund companies. The only fundamental difference of an ETF is that ETF can only be bought and sold on the stock exchange. It is listed on the stock exchange and it can be transacted into in real-time basis. What does that mean? From a mutual fund point of view, if we were to invest 100 rupees in any XYZ scheme, you would get the NAV for the end of the day. Versus that in an ETF, in the same scheme, for example, let's just assume that there is a fund which has got a mutual fund format and which has got an ETF format. In the mutual fund format, you would get the NAV for the end of the day. In the ETF format, you will get it live. The NAV can also like a stock price move, but it won't, really fluctuate the way you see stock prices, but it tends to move. It tends to go up and down, you see, and which is where you can actually purchase in real-time basis. Let's bring the presentation back. So principally, ETF is absolutely identical, manufactured by the same mutual fund. But there is a fundamental difference here. See, in a mutual fund, what is happening is that the fund manager picks up a certain kind of a theme. And the theme could be that it's a blue chip fund, or it's a mid cap fund, it's a small cap fund, or it's a pharma fund. And what the mutual fund manager does is, based on his and his team's research and analysis, they would create a certain portfolio. So, for example, it is blue chip, and they tell us that this blue chip portfolio is made of the top 100 companies of India. And then they would do their analysis, use their objectivity, subjectivity, their judgment, and create a portfolio for us. And we are investing. And then what they are doing is they are from time to time modifying, rebalancing the portfolio and doing what they have to, basically to ensure that we have a good investment experience which is we make great returns and, despite the volatility, we don't lose anything, and which is what we've seen over so many years. So that's an example of blue chip. The fund manager on the other side might make a similar thing from a small cap or from a mid cap. The fund manager may also decide to make a sectoral fund. And what I mean by a sectoral fund is the fund manager could think about saying that, okay, let's launch a pharma fund. So somebody who's wanting to invest in a concentrated format in a pharmaceutical fund, then it's called a pharma sector fund. And they create a fund, and actively the fund manager is buying and selling pharmaceutical companies as part of his rebalancing in the pharma portfolio. Now, how is ETF different? See, ETF is largely going to be in similar fashion, but playing on index. So, for example, the fund manager makes a blue chip fund, but the fund manager of an ETF would actually like to follow an index. He might follow the Nifty, he might follow the Nifty Junior, he might follow the mid cap index, or he might even follow the pharma index, or he might follow the infra index. Now, here is a case in point, which is very, very important to understand. And let's talk about pharma, since that's the word that I'm playing with. Okay. It's very interesting. In an active fund, which is a mutual fund that the fund manager runs, he buys and sells companies from the pharmaceutical and the healthcare space. In an ETF, on the other side, there is already a predefined index which has been created by National Stock Exchange or the Bombay Stock Exchange, the two popular exchanges on which we do most of our operations, right? A pharma index or a healthcare index is predetermined. That index comprises of maybe 8 or 10 or 20 different stocks, different companies. That index remains constant. That index is rebalanced, or the constitution of that index is changed when the exchange decides so. Big difference here. Please understand this and let me repeat it. In an exchange traded fund, example pharma, the National Stock Exchange, NSE, has already created an index called Nifty Pharma Index. If that index has got 15 stocks, for example, then those 15 stocks are bought in the ETF directly. Versus that, a fund manager who's managing an active pharma fund, he will look at the pharma index, but he need not buy the same pharma 15 stocks. He will buy stocks based on their research, their analysis, and their judgment. So that's the fundamental difference between an ETF and a mutual fund when we are talking of a specific example. Okay. Just give me a moment, guys. Sorry, I'm back. Okay, let's have the presentation. So, principally, very, very similar, but the ETFs are just like stocks, just very, very fast to trade, to very, very fast to buy. And the beautiful thing about it is, if at some instance you feel that I think this pharmaceutical sector is looking fabulous. I'm just using pharma as an example. This is no recommendation of promotion. I just want to repeat that. I'm just using it as an example. So if we feel that the pharmaceutical sector is now going to benefit because of A, B, C, D, E, F, G reasons, whatever might be your reasons, or whatever report you've read, the quickest way to take exposure or to take advantage of the activities that are happening in that particular space is through this ETF mechanism. So click a button and it's done. Within seconds, within milliseconds, you have, a whole basket of beautiful pharmaceutical companies right in your portfolio. The difference again is you don't have demat shares of those companies. You have units of XYZ mutual funds pharma ETF. Okay, that's the difference. Just the way you have units in a mutual fund, you will have units in a ETF. Okay, now let's move forward. So what does the ETF universe today offer? See, from a mutual fund, you already know, and I'm going to keep drawing parallels to the mutual fund world. You have, like I mentioned, the blue chip, diversified funds, debt funds, liquid funds. I mean, all sorts of funds we have, right? Sector funds. In the space of ETFs, you have equity ETFs, pretty much like your mutual funds, which can be broad market. And what does broad market mean? It means ETFs which are based on indices. Today, we have more than about 150 indices. I mean, we lose count because there's so many indices also that are getting created regularly. Perhaps you all can share with me what's the latest count of the index, I mean, as we move along. But there's a significant number of them, right? And we are very used to only the top 3 or 4 indices. We are used to Nifty, Sensex, Bank Nifty. We are used to mid cap, small cap, and some people might know finance index, but there are more than 100 indices. Okay, so there's so much of variety, and every index can have an ETF. So it's amazing. It can be broad market or a sector specific, like I mentioned, pharmaceuticals, infrastructure, tourism, real estate. It could be, a lot of variety in the sector. Debt ETFs are very straightforward, just the way you have mutual funds which invest in government securities and state government bonds and RBI bonds. You pretty much have the kind of debt ETF also. Commodity ETFs are silver and gold. Now that's the only way pretty much you can buy gold and silver. Yes, you can buy it in a mutual fund also, but when the mutual fund creates a fund, he normally has an ETF fund within the mutual fund. So basically, the mutual fund is only giving you an option saying that if you don't have a demat account or don't want to bother using your demat account, you can buy gold and silver through that mutual fund. But when you give the money to a mutual fund, that mutual fund in effect will put money into the ETF created by its own self. So if a company X or a mutual fund X is giving you a fund, they will normally invest in X gold ETF or X silver ETF. But that same X is also listed in the market where you can directly pick it. Then there's another innovation happening with the exchanges, which is known as the smart beta ETFs. This is another world in itself. We will talk about that separately. But basically, they believe that there can be indices that could be made based on stocks that are like fastest horses, fast momentum, or stocks that give you the least amount of volatility. So there's so many concepts and ideas that they use. But like I said, it's a different world. We'll speak about that separately. Otherwise, we'll get very, very we'll just move into a completely different tangent. Don't want to do that. And then, of course, there's international ETFs, which some of you are aware of. I mean, what if you wanted to invest in Nasdaq, or if you wanted to invest in the American market? You have funds, but there are listed ETFs also, so you could just buy the ETF. And even if you buy the fund will buy the ETF, right? So that's how basically things work. Now let's show you some numbers. I'm just showing you the background of what this in ETF universe is quite interesting. Once you do that, then I'll actually get into the strategy and tell you why and how this can be a very, very interesting, activity to get into. All right, as you can see here, we have a lot of funds that are available for us to invest. Some total of 497 products are listed for us to operate in. Can you imagine? And this is all, just happened in the last, couple of years, last actually 1 or 2 years. And this is as on 2nd of December. We have 497 different instruments in which we can invest. Of course, there is going to be repetition. There could be a NSE ETF, but listed on NSE also and BSE. So you see, in totality, we have about 285 products on NSE, and this is just increasing by the day. But what is very interesting is look at the number of sector ETFs. I mean, 160. Strategy, like I mentioned to you, we'll speak about that separately, but there's so much, there's so many themes. This is the really interesting bit. 160 and 53, which is almost 200 plus very, very interesting products, and which is capable of giving us exposure into a whole variety of exciting areas and really efficiently. Let's get into a little more detail on this. Okay, let's show you. So, for example, actually, can you bring me that Excel where I can see the detailing of that thing? We'll show this slide a little later. So what happens is now we have 500 products, but there is a lot of diversity in this 500 products also. and which is what I want to try and show you. There is so much of depth, and you'll be amazed when you see the depth. So here is the, let me just start my markers again. Here's that 497 that I was talking about. But look at this. Now, you know what you guys can do? Can you just click on the broad market one and show us the diversity there? Now, see, these are so many indices that you have, right? BSE 500, Sensex, Next 30, there's China, there is international, and there are so many different options, and each one of them is a product. I mean, if you wanted to invest in a, in an Islamic kind of a Sharia compliant fund, there is a Nifty 50 Sharia index also. This amazing. There's so much of development that has happened around. So you'll see there's so much of variety. It's just not Nifty, it's just not Sensex. There's so much of mix and match. For example, if you just wanted to be ultra conservative, look at Nifty 500. You buy in a single click, you have invested in 500 companies of Nifty, all the major companies of this country. Amazing, right? I mean, where do you get this kind of facility? Of course, your exposure to each company is quite minuscule, but that also depends on the size of the investment, right? Okay, you can shut this packet and let's further go down. Let's not go into debt. Let's go into sector, please. So let's share with people what these sectors mean. My goodness, now look at this. You can invest in a basket of power companies, capital market companies, automobile companies, chemicals, commodities. You can even invest in public sector banks if you just wanted that as space. Or you could even invest in, say, private sector. I mean, pharma is, the example that I've been using so far. But there's so many pockets, right? Now, for example, if you look at gold has become so popular that there are 41 products today available just to do work. They are all the same, by the way. There's no difference. So everybody follows the same price of gold. Everybody tracks the same thing. But just look at the amount of participation that manufacturers have shown, because every company wants to launch their gold, or a huge number of people have launched their banking index or the banking ETF, because obviously there's more interest in banking, and which is why you see so much of products there. You see a humongous number of products again in silver, because there's 26 different products available for that. Private banks have about 14 products available. So there's so much of diversity, and there's so much of participation, because we as investors want to participate, and manufacturers want to also provide us the opportunity, and which is why so many products have got created. Very quickly, I want to show you themes also. Can you please give it themes? Okay, for a minute, I want to just speak about, before I get into this, just for a tiny minute, I want to get about and explain you the difference between a sector and a theme. Okay, very important to understand. A sector would be companies in the same industry. For example, let us say real estate. Okay, to give you an example, real estate is a sector. So all the companies who are into real estate, for example, most of the developers that we have in our country. So amongst those developers, whoever has a listed company, obviously, would all be comprising of a real estate index. Or if you wanted to, say, buy a basket of companies, it would be these developers. Okay, purely people who are in the real estate business, right? But the theme could be housing. If you look at housing as a theme, then you might have some developers as a part of it. You might also have suppliers of pipes into it. You might also have suppliers of paint into it. All the things that are needed for housing. I mean, if you look at housing as a theme, then what are all the things you need? Furniture, you need construction companies, you need developers who will sell you the apartment or the office space, and then you will paint it, you will do furnishings, you will do interiors, textiles for fabrics for home and for decoration purposes. So all these companies would become a part of housing. Okay, so housing therefore is a theme. Giving you another example, say steel. Steel is a sector, or power is a sector. Only power companies will form the power index and will be known as the power sector, or steel companies will be known as a steel sector. But if you talk about a theme, infrastructure is a theme. Now, infrastructure as a theme may also use a power company, may also use a steel company, Infrastructure might even have a construction company as a part of it. Infrastructure could also have a machinery company, somebody who's manufacturing machines, somebody who's also manufacturing automobiles or auto parts which are needed for that machinery that's going to be employed. All this becomes part of infrastructure as a theme. So you understand the difference between a sector and a theme. Sector is companies belonging to the same industry in a very generalistic format, and theme could be all the companies that are related for that particular activity. So, giving you more examples of theme, housing was one, infrastructure another one. Tourism is a theme, right? There's so many things that happen in tourism. There'll be hotel companies, transportation companies, airlines, everything becomes a part of tourism, right? So now let's go back and show you the diversity that today exists in the space of themes. Yeah, can you just put up the same picture again on themes? Yeah, so now we have so many themes, right? Healthcare becomes a theme. Pharma is a sector, but healthcare is a theme, right? Because healthcare can also have hospitals and laboratories, which is not really pharmaceuticals, but pharmaceutical purely means companies are manufacturing medicines and medicinal drugs, etc. Internet is a theme. Then you have ESG, which is environment, social, and governance. I mean, look at this nifty. I mean, there is something called automobile, and there is a theme of electric vehicles. There are funds based on that. Electric. There are 5 products on that. Imagine. There is something based on railways and tourism. Just see the amount of diversity. There's so many products, so many interesting baskets of investments that have emerged for us to take advantage of, to invest. And the best way and the only way is to do ETFs. Okay. I mean, ETF is the way forward, by the way. Okay. And we can bring the presentation. So, ETF, by the way, is so interesting. In India today, we said that we have about 500 odd products, 497, just rounding it off to 500. US market has close to 5,000 products. And don't be surprised if you see thousands of new products being launched continuously over the next couple of years. And we will also probably go along the ETF way. India will also go along the ETF way. So I'm very excited about this space, and there's lots that can happen in this space. Okay, so how do you build your ETF portfolio? Now we'll get into the actual, let's take the sand shovel in our hand. Let's talk about how do we build our ETF portfolio. So typically, what do we do in mutual funds? We also do overall these kind of strategies: conservative, balanced, aggressive. That I want to have 50% of my money in equity, 50% in safe. So overall, starting or from the umbrella, we will have that kind of an allocation always there. Now, for example, let's just speak in terms of one example. Let's say balanced, right? So if you wanted to put 30% of your money into fixed deposits and state government bonds and central government bonds and RBI bonds and all of that, so that becomes your fixed income or debt portfolio. 30% goes there. 70% you want to invest in equities. Now, this 70%, this is an example, okay? This is just an example, not recommendation. Again, example. You could be wanting to distribute your 70 rupees, your 70% as some of these things. So you might want to invest 5% of your money into Nifty. Nifty is nothing but the top 50 companies of the country. Then mid cap means you want to invest in the next 150 companies. Then a basket of banking stocks, a basket of financial services. Financial services banking is different. Banking is pure banking. Financial services might have some banks, but financial services also means companies who are NBFCs and companies who are providing different kind of support services to financial services. But again, financial, small banking services, microfinance, a lot of those. You could be into a theme of infra here, as we've said, or you could even be into automobiles. Say you want to create a portfolio like that. Just giving an example, right? I'm not sure if this totals this 20 and 30 and 40, 50, 65%. Yeah, it's not exactly 70, but again, this is just a demonstration. Maybe 5% you want to keep cash. So what happens is, and here, for example, if you're very bullish on defense, for example, then you may want to allocate 15% of your money into defense. So if you think that defense is a great place to be, then you can even, by the way, you can even increase and change and increase it, decrease it. All you need is a demat account and your phone in your hand, and you can just go clicking. Is so easy, so fast, and it's so amazing. That's how you can build their ETF portfolio. And like I said, there are lots of products. Oh, by the way, another clarification. You saw that there are 500 products, but you don't have to get enamored by that. For example, the highest products or number of products would be, let's say, for example, our Nifty. But say infrastructure is a theme. You wanted to invest in infrastructure. There may be about 10 products, and it doesn't matter who you choose. But the best part is you don't have to decide whether X mutual fund or Y mutual fund or Z mutual fund, which is better. See, there's a big difference there. Okay, very big difference. When you are doing mutual fund investments, okay, in mutual fund investments, we have to see which fund is performing better, which fund manager is doing better. Is mutual fund X doing better than Y, or Y is doing better than Z, or Z is now not doing so well, so we need to change it. This problem is not there in ETF. There is no comparison. You can have the same ETF, say infra, from mutual fund X, Y, Z, A, B, C, D. There could be 7 products. It doesn't matter which one you choose. Okay, now, take it with a pinch of salt. Okay, so where I say it doesn't matter which one you choose, because conceptually, the basket that they are going to invest in is going to be the same, because that's the index that has been provided by NSE or BSE, right? So where your money is going to be ultimately invested is the same. The difference is that company X might want to charge you a certain fee of maybe 0.3%. Company B might charge you a fee of 0.4%, and company Z might charge you 0.6%. So that's the variation, and that's the difference. But broadly speaking, these are very small. Nobody is really there where you don't have a comparison where somebody is charging you 0.3% and another company is charging you maybe 1.5%. There is not so much of a disparity. The disparity is small, but it's there. Okay, but whichever one you choose, principally you will be in the same place, and obviously it's fairly discounted from a mutual fund point of view. Yeah, of course, there is a tracking error kind of a thing there, as Gagan, absolutely right. But I didn't want to speak about something so technical, but we'll talk about it the moment we move to Q&A, but we'll talk about it for sure. But for now, friends, just understand, broadly it's the same, conceptually is the same. There might be a little 19 kind of a difference in fees. Okay, so don't worry about that. Now let's go next. Now, why we should do this kind of thing? Let's move forward. Let's go dig a little bit deeper into it. And this is the best part, okay? Why we should be doing this thing. Can you now bring out that amazing grid that we've made? This is, guys, this is some fantastic research that we did. And this is beautiful, okay? Now, let's, for example, okay. Well, first thing, what you need to do is you need to just increase the size a little bit. And the second thing you need to do is, can you please filter on 2025 as the year? Okay, great. So friends, now this is the report card for 2025. Just make it a little bigger if you can, and if you can just do a little bit click here, so that the screen increases a little bit. If you just kind of shut your toolbar, if you just shut this toolbar here, the screen will increase a little bit, and then you can just expand it. Thank you. Yeah, good. Now just do this is a Google Sheet, right? So you can do a Control Plus. Just sort of expand it a little bit. One more. Okay, perfect. Very nice. We're good. All right, friends. Now look at this. Okay, very, very interesting. Look at okay. By the way, this is data from January to December for this calendar year. We are in December, right? So perfect time to talk about ETFs. And I think this is what we are intending. As a system, every December we will talk about ETFs. And increasingly we'll have to talk about this, maybe not only in December, but other months also. But this is such a big area, such a big developing area. Okay, now look at this. Nifty, for example, has done 10%, okay? Calendar year. But mid caps has done about 5%. Technology sector is minus 10%, and small caps, I mean, these are the popular ones that we have, okay? Small caps are at -3%. So if your portfolio today is say 30% on blue chips and large caps, another 60% in mid caps and small caps, and maybe you have one or two sectors in your mutual fund portfolio, say maybe IT, maybe FMCG, you would see that your portfolio return is virtually zero or plus minus 5 for the last 1.5 year. Why does that happen? Because as you can see, small cap here, and if you can just click on 32, so you know exactly what we are looking at. Or you can take your cursor there, yeah, 32. If you can just select that, yeah, and I'm just going to circle. See, small cap as we speak is -7%. So obviously it's a degrowth. And if you are half invested in small cap, half invested in Nifty, your annual growth for the year is zero, because +10 -7 is basically 3. So nothing really much worth to talk about. But in the same year of 2025, which has been the highest performing sector, 27% returns has been brought in by PSU banks. Very interesting. So if we could have had 20 or 30% of our portfolio or 40% of our portfolio in this, our returns for this year would be so much more handsome and better versus what it is. Now, automobile is another sector, done 22% for the year. Now, there is something very interesting that has happened. Whatever green patches you saw or you're seeing is actually a good positive period. So this entire period was good for the automobile sector. February was bad for everybody. So everybody was bad in February. But then March, April, May, June was, if you remember, there was tariff happening. The Operation Sindoor happened in all this period between March and June. Nothing really was happening. Tariffs continued in July, August. Again, nothing was happening. But then somewhere in September, October, November, the GST reforms and the other little policy announcements that happened actually helped this particular sector, and the sector actually moved up. And we could have come home with 27 and 21% returns in this particular sector. Now, I know all of you are thinking, but okay, now this is post facto, right? We've analyzed, we've seen this data, but is there a way to find out? Is there a way we can predetermine something like that? Now, that brings us to a very important sort of a matrix. Okay, we'll talk about that in just a bit, but I just remembered. Can you bring that back up? Okay, let's go to another year. Okay, again, we'll just see something. I just remembered something very interesting which I want to share with you. Let's just go back to the same thing. So we filtered on the year 25, right? Let's now filter on the year of 22. Let's just take an example. 2022 is an example. Now remember, one second. Everyone remember, which was the good performing sector for the year 25? It was auto and PSU banks. These were the top two areas or these were the top two highest performers of 25. Let's look at 22 and see what was the scene there. Okay, let's go to 22. Okay, very interesting. Now, in 22, again, PSU Bank was at 70%. Okay, incidental, I didn't know this one. But at the same time, metals did 21%, and banking also did about 21%. Okay, look at the diversity. So different. Okay, small cap here, again, in this year, did a -4%. Look at the diversity. Now, let's go to the year of 24. Okay, I'm just taking some years at random. Okay, let's look at 2024. Let's see what was the leader sector there. So in 22 and 25, we saw PSU banks be the leader. Let's see 24, and we saw metals and Nifty. Now let's see 24. What do we get? Okay, who is the highest performer here? 34%. At 34% is micro caps. Okay, so micro cap was the highest sector here at 34%. And anybody higher than that? No. Okay, so 34. And another 34 was generated by real estate in this particular year. Okay, and another manufacturing actually did. There is an index for manufacturing, by the way. So manufacturing did 25%. And you had, who is this at 24? This is mid caps. Mid caps did 24. So now see, in this particular year, PSU banks give a very ordinary return. Metals also didn't do anything great, 7, 8%, 8% odd. It's very, very different. Every year is so dramatically different. Let's go to 21. Let's see what happened in 21. 21 was the year after COVID, or I mean, 21 was also a COVID year. And remember, we also had a little bit of a lockdown in this particular year, right? Okay, this year is looking so much more greener. Okay, look at this. We had 69% returns produced by metals in this year. Amazing, right? And we had 62% returns made by small caps in 2021. And 54% was generated by realty. So realty actually 21 and 22, both the years realty did fabulously well. And this year, incidentally, all the people with the most conservative investors were also a very happy lot because Nifty itself, the bluest of the blue chip companies, also gave a 24% return. I mean, these are the best names of India. They gave some fantastic returns. Technology in this year did 60%. See, we didn't really see technology playing any role. Guys, friends, do you see what I'm trying to bring at? Different sectors at different points are performing differently. In different years, leaders are different. In different years, winners are different. And because of that, is there a way by which we can take advantage of this information? There is data for this also. And I want to show that data. And this is another very interesting piece of data. I'm throwing a little bit of data, but this is the last piece of data. But this is the clincher. This is there's too much happening here. Okay, very simple. Abhi ek kaam karte hain. Do me a favor. Okay, basically, let me first tell you what this data is. Okay, this data is tracking. We made this little model to track. If we are talking about, for example, the first theme here, aerospace and defense. Okay, so if you're talking about aerospace and defense, this particular theme here, we have simply added all the companies in this theme, and we have tried to track and record what was the sales that these companies did, what was the profits that these companies did, and what was the growth of these companies. Okay, so this data is basically trying to tell you that. Don't try and read anything. I will guide you through that. But I just wanted to tell you first what you are seeing on your screen is an aggregation of all the companies in that particular sector, industry, or theme, whichever way you find comfort and understanding. Okay, so that is what is happening. For example, tractors, then all companies who are into tractors, their profits were accumulated, their sales were accumulated, and we saw the average growth that they were having. Why are we doing this? Now let's do a very, very quick, just a moment, for just a moment, take this off the screen. Why do we look at these kind of data? Why do we look at sales? Why do we look at profits? The thing to understand is, and a lot of you who've spoken to me and where we are interacting regularly, you know this for a fact that I keep saying, what is the barometer that the market is going to go up or market is going to go down? How do we decide आगे क्या होने वाला है? How do we decide market क्या लग रहा है? How do we decide any of these things, right? The answer that you've heard from me a lot of times if you've interacted with me is very simple. Number one, we look at the GST data. Is the GST moving up? That means somebody is buying something, because that's why when you're buying things, you're paying GST, and that company in turn is paying GST to the government. So is the GST data moving up? If the GST data is moving up, then obviously that means that there is a lot of purchase which is happening, correct? Next data is tax data. If taxes are moving up, then again that means progress happening in the economy, and as a result of which, it's a positive sign. The third and the most important number is, in that particular sector or industry, are those companies making profits? Are the quarterly profits looking good? If the answer is yes, markets will move up. Stock prices are subject to movements based on the profit of the company. If there is profit, there's going to be appreciation in stock price. Simple. Now, it's a very, very simple to understand concept, but the most important concept in financial management. If the company does profit, the share price will go up. The share price goes up. If the shares are included in your mutual fund or your ETF portfolio, the value of their NAV will rise. Very, very simple, very straightforward concept. Okay. Now let's come back to that sheet. Now let's show you something very interesting. And that way you can actually, you can do it yourself also. Data in India, by the way, I keep saying, right, data is freely available. So some places you have to pay, but otherwise it's freely available. But it's just that you have to, do some processing of the data. Okay, now what I would like you to do is for simplicity's sake, can you please hide columns D to, we don't want to see. So columns from D to K. Can you just hide them off? These are just independent quarterly sales numbers and profit numbers, which, from our discussion point of view, not really required. What is required is, now can you please increase the size of these numbers? Can you just do a little zoom out? Okay. Yes. Fantastic. Very good. Very, very good. Very good. Very good. Thoda sa aur kar do. I mean, do a little more. Do a little more. A little more. Thanks. Okay, good. Let's go on top. Now, these numbers are large enough for everyone to easily understand and see. Okay, what do you see in front of you? And let's focus on column L and column M first, okay? L and M. L is telling you the average growth in sales. Now, see, I mean, basics of business, right? If you have a higher turnover, if you sell more, the chances of profit that you will accumulate for the year automatically rises, isn't it? So that's what we are trying to show. Now, for example, aerospace and defense, the sales grew by 30% in the last 1 year. Okay, amazing, right? And the profits grew by 240%. Average profit of all the companies in this particular sector. Got it? That's what this means. So if the sales has grown 30%, if the profit has gone up to 45%, is this a place to invest? Yes or no? Very simple answer. You can decide. Correct? Now, let's sort of move down this column. Let's go a little bit down. Okay? Wait, slowly. Now, for example, let us, for example, look at agri products. Okay? In agriculture, look at sugar, for example. What was the sales growth here? Remember, column L is, let me just write it for you, okay, on your SALE, because that thing is not visible, and this is profits. Okay. Sorry for my handwriting, but sugars, the sale went up hardly 0%. But the profit actually went down, means they made losses, something wrong. Sector to avoid. Okay, tea and coffee. Now look at tea and coffee. Very interesting, okay? Let me just clear the drawings again. Oops, I lost sales and profit. Okay, S&P. Let's look at sugar. Tea and coffee. The sales went up by 23%. So there was a 23% growth in the aggregate sales of all the companies, in the business of tea and coffee. But the profits only went up by 10%. So, I mean, both these things have to work for the stock price to move up. This is not such an interesting sector to go into. Leave it. Now, for example, for example here, let's say auto components and equipments, 10%, 7%. I mean, not so interesting, right? So we can skip that. Then look at this one. These are auto dealers. Now, auto dealers, 28% growth in sales, but they are actually, there's a degrowth or maybe a little loss. You see, negative doesn't mean that it's a loss, okay, necessarily. It just means that the growth has been lesser. So it's actually, that means the growth is not positive growth, which means last year if the profits were at 100 rupees, today the profit is at 70 rupees. Therefore, you're seeing negative 30. But there is profit. But sometimes it can be a loss also, okay? So please understand. Oh, now look at this. This is a beautiful example. Let's look at banks, okay? Focus on banks. Okay, just make banks in the middle, okay? Banks. Very interesting. Look at private sector banks. Now, who are the private sector banks? Most of the banks where we have our accounts. Okay, I'm not taking any names, obviously, but private sector banks are the banks that we bank with. Modern banks, the modern Indian banks. Okay, growth in sales 8%, profit degrowth 5%. But on the other side, just look at their counterparts, the public sector banks. Look at their sales. Their sales are also at 10%, nothing great. But look at the jump in profits, guys, friends. Look at this. 24% growth in profits. So if I had to make like a crystal ball kind of a prophecy, will this sector move up? I mean, the answer is probably, profits are good. Profits always dictate the prices, and therefore maybe this becomes an interesting opportunity. The same thing is applying here. See, profits in breweries, distilleries is very nice. Profits in, who's this? 78%. Exchange and data platform. Oh, by the way, we did a whole session on data centers amongst our, as a part of our MMF sessions. You can have a look at the video if you want to. Cement production, 42% growth in profits. See, this is data. And if decisions are made on this data, I mean, you can't really go wrong, right? Now, there is another thing also, which I want to show very quickly. Can you please also show us a chart of PSU Bank? Because we just spoke about PSU Bank, right? So you can show us, or you can show FMCG also first. Yeah, we can show FMCG monthly chart. See, along with data, we also look at price movement, right? Because that kind of has to move together. Not necessary, but it's just a good idea. I mean, if you want to also have a look at it, you can also have a look at things. So now, for example, this is no, just compress it completely, and just remove all your indicators. I mean, you can close this indicator also. You can close all the diagrams also. Yeah, just give it a clean diagram. Okay. Look at this. This is the chart of a PSU bank in terms of how this bank as a group has moved. Okay, all PSU banks. So you can see that PSU banks had a great sort of a rally between 2020 and here, which is 24. Then it kind of went down a little bit, but now maybe we saw that the profits are good. Maybe there's a rally which is like okay. In the same way, can we look at, for example, maybe some other, let's just look at FMCG, for example, okay? Now see, okay, now the very nice classic example. See, FMCG was kind of moving up, no problem, but there's something wrong, right? It is stagnating, it is kind of moving sideways, which means obviously there's not so much of profit happening. And FMCG means like a huge basket of a lot of products. What we showed you was profits on even smaller sections of FMCG. Like I showed you the agriculture, I showed you sugar, I showed you some of the other places. The profits are not good. So which is why you see this kind of a lag happening that, So maybe this is not a area of interest right now. Let's look at healthcare. Let's see what is happening to healthcare. Okay. Healthcare, yeah, healthcare seems to be, I mean, this is just price action, okay? It's common sense. Without even knowing how to read charts, I'm just explaining you. Upar gaya, it came down, and now it's kind of, you know, it's just inertia and those basic things that we learned in school. That if there is a direction that is going on, that direction continues till the time the direction changes. So that's it. So right now the direction it was first up, it went down, now the direction has become up. So maybe something good is happening in this space. I mean, that is all I want to try and submit. Of course, there's a lot more detailing that is done in studying all of this. And some of you, if you are looking at charts, you know what I'm talking about. But having said that, most important thing to understand is profits. If the profits are good, and if you have an option to buy, click on a button and buy the ETF, why wouldn't you do that? And that is exactly what we are trying to submit here in this particular section of our special MMF on ETFs. And we will do one more, of course, as time permits, as we move along.